Now, the number of personal insolvencies, so businesses and people going broke, is expected to rise in the next 2 years. That's according to data released this week by the Australian Financial Security Authority. High costs of living, clearly, including interest rates and growing economic uncertainty, are expected to drive the rate of personal insolvency in particular higher. And that's a big turnaround from the recent historic lows, which were due largely to the introduction of the Morrison government's JobKeeper reforms, plus also changes to bankruptcy laws back in 2020 that kept many companies afloat. With that uncertain outlook, this week I spoke with Jason Ireland, a partner at the insolvency and corporate restructuring firm McGrathNicol.
There's no doubt that 2023 will be a tougher year than 2022. You've got those pressures mostly downward on demand, and you've got costs rising, at best stabilising, but many of them still rising. Inflation, interest rates still going up.
OK, but then you've had a very prosperous period in Australia's economy, and you've had those record low interest rates. So a lot of company managers, if they're doing their job properly, should have been building some buffers, a little like the Reserve Bank is hoping that households have built their own buffers as well.
No doubt. You can have a look at it. One perfect example of that, hopefully, is retail. So we're seeing doom and gloom on the consumer sentiment outcomes that might play out in 2023 for retail, but they've just had 2 record years in a row in that sector. So you hope that that sector and those participants have built resilience in the last couple of years. OK,
but then the one thing that is saving Australian households right now, and therefore businesses, is that the unemployment rate is so low. And so even though there might be some pressure in terms of inflation and rising interest rates, people are coping because they actually have employment. They have an income coming through. We've seen it in the tech space in the United States, especially where job losses are now starting to mount. But here in Australia, that hasn't started yet.
That's right, it hasn't started yet, and there's no real sign that it will, except if we see some business trouble. But businesses still report it being tough to get people, and they still report that wages are actually increasing. So you're right, that consumer is still enjoying high employment, fairly okay wages, though real wages with inflation going so hard are still going backwards, but fairly high levels of employment, which we haven't seen for a number of years.
OK, so then I want to go and test any company's ability to continue to try and expand their workforce. There's a point, because high inflation is generally associated with higher unemployment. There's a point from a cash flow point of view where companies say, I no longer see the need to employ somebody. I'll either try and find other efficiencies, I'll do without the workers. So I'm wondering at what point that starts to show up. And the unemployment rate, we know even the Reserve Bank, Treasury, they say the unemployment rate eventually ticks up, but it doesn't really get out of control.
I think that's right. I mean, what we do know about all of those technologies which eventually take people out of the process is they take a while, and then they take a while to prove themselves up, and they're expensive. So I do think there's some protection there for the normal unemployment rate to stay at a fairly low level for a while. I mean, we are starting to see the borders opening up, so hopefully that gives a little bit of a push for availability of people. But I do think we'll see a period of lower unemployment for a while because, as I said, it's very expensive to take people out of your process.
All right, now, there's another aspect of this, because you reported last October that the working capital of Australia's largest companies had diminished significantly over the course of last year. Now, this is not a good sign. When you're giving advice to some of Australia's biggest companies, as you do, you're now starting to have to try and prioritise where their capital is going to. Now, this either means, number one, those companies have got to start to think about cutting back, or B, they've got to start going back to reluctant shareholders to raise more capital. How does that dynamic work?
That's right, and there's a third party there, which is the financiers, and they'll be tougher. So it might well be capital. There's no doubt what we saw when we last spoke about the working capital trends throughout 2022 was that it got harder to manage working capital. The majority of that was focused on inventory. People needing to, because of disrupted supply chain, they needed to build inventory stocks in a just-in-case rather than a just-in-time. So that's only certain industries. So, and we've seen some of that release throughout the last few months as retail, for instance, have had quite a good Christmas, New Year sales period. So businesses, as they go into 2023, have got to focus and think about managing for cash more than ever, because they will see pressure on their P&L. So then you need to turn to, okay, I need to turn that perhaps smaller P&L into cash flow faster. So that's working capital. There's no doubt that becomes more important this year.
Okay, but then when I try and figure out what are the sources of that cash flow, number one is more business. So trying to generate more business. But as we've already agreed, the consumer is going to be increasingly reluctant, right?
Yes.
Then there's the other side of it, is cutting costs. You can actually then look to cut costs, and or you can do a deal to sell an asset, do something along those lines. So this is where there's the dynamics in running a business, big or small, doesn't matter what it is, right now become more complicated than what they've been for the last couple of years.
Absolutely. I call it's a very high maintenance year this year. No doubt. You've got to be watching top line, bottom line, and then making sure that the net of that comes through to you quickly. I talk about cash flow in real terms, but also the pace of it coming to you is worthwhile not forgetting. So if you made $100, but it takes you 6 months to get it, making $90 and getting it straight away is better. So working capital and working on cash flow is just as important this year as your top and your bottom line. So no doubt profits will always turn into cash flow, and it's better to have profits, but cash flow is just absolutely key to keep you, to really see you through that stormy period where it's a little bit uncertain. Provided you're still turning your cash through your business, then you'll feel a little bit more confident.
Okay, so are there any sectors, any areas right now that you see are potentially more vulnerable than others that you're actually keeping a weather eye on to see whether there's insolvency or restructuring or something needs to happen?
There's two very clear sectors which are at two different inflection points, I think. You mentioned one before, retail. There's a lot of media and a lot of discussion about, is this the year of reckoning for retail? And when I look at that, the inflection point will be, well, revenue's probably going to come off and costs are probably higher. So have they built resilience coming into this period? So that's a sector.
So those retailers that would be most vulnerable there are those that have giant warehouses full of stock. If they can't clear that stock, or they've got to clear it at a loss, then they've got fundamental problems. If you're a retailer that only orders yourself when you receive an order, then you're a safer retailer in some ways.
I think that's right, but I'll keep coming back to cash. If you've got a warehouse full of stock, you can sell it for a loss on real retail terms, but you're still making a profit on that stock because you bought it well.
Yes.
You bought it well throughout last year. So you're working for cash. And so your profit may not matter too much to you because you're still working cash flow through your business. So for retailers, I think the retailers that are the most under pressure will be ones that didn't use the last 2 years to build resilience. They didn't use the last 2 years to really understand their customer and make that customer sticky, and they didn't use the last few years to really invest in their technology so that they come out of that truly omni-channel ready.